Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. We have webinars, as you know, each and every week. In fact, this week we have two, and today's going to be a great one, as I have as a special guest Jack Crooks from Black Swan Trading. And Jack is going to be talking about the risk and benefit to the global currency market. I think you're going to find this extremely insightful, as everyone, whether you're trading equity options, index options, ETFs, everybody wants to know what impact that is China going to have on what they're trading. Of course, currencies have a huge, there's so many ways to trade currencies, and whether you're bullish or bearish, you can just, quite simply, if you're trading ICFX options, buy a call if you're bullish on the dollar, and if you're bearish, you could be buying a put. There's lots of ways to trade it, but Jack's going to be talking about the market itself and how you could be looking at it, some things to look at in the future, so hopefully that'll help your trading. Without further ado, I want to welcome Jack Crooks from Black Swan Trading. Jack, thanks for jumping aboard today. Really appreciate it.
Thanks, Steve. Thanks for having me again. I do appreciate it. And thank you for joining everybody. And as Steve said, just go ahead and type in your questions as we go along. If something pops into your head, and Steve and I will hopefully have a chance to answer all of them at the end. And also, if there's something in the presentation that, just really funky and you want to think about it and send a question our way, you can just send it to Black Swan, and we'd be happy to answer that in that way too. So we'll go ahead and get started. Let me just say before we get started what this is about today. We're going to look, kind of just step back and look at China from really a bit of a risk-reward outlook. Really what's happening from a global macro standpoint in China relative to its relationship a lot with the U.S., which really is a microcosm of its relationship with the other Western countries in terms of trade, how it impacts its currency policy, how it has impacted some of the Asian countries, what the capital controls that they have, and what the benefits might be if they were to, let their currency run. I gave a presentation to the Chinese in Beijing probably a little over a year ago, I guess, maybe it was April 2008, and I presented a lot of things in terms of the symbiotic relationship. I think it was even before that. Actually, it was in 2007, but I forget the date. But had a lot of big wigs from SAFE, State Agency and Foreign Exchange there, and things. But they really weren't in the mood to listen to anything I had to say. They're very, very righteous in their view of how they see the world in terms of their currency, and they have some legitimate reasons for the policy they have, and they also have some serious concerns about changing their existing export policy and the capital control policy. So from their standpoint, they really have some legitimate views, but I think ultimately now that we've reached this stage in the global economic environment, it would behoove them to start loosening up and allowing some of that money to get out of China in terms of capital controls, and we'll get to that. Their whole policy now, I think, is setting up for a real problem in the global economy. And again, it stems from their specific export policy, which really ties them up on the currency side of the fence. They kind of go together in their mind. So this is kind of a view, walking you through that, why they view things the way they do, and why I think we've got a real problems on our hands here if things don't change. We're already starting to see some major belligerence developing in Asia relative to China. Asia Bloc ex-China behind the scenes is very, very upset about what's going on in terms of China, trying to push this adjustment off onto them, their trading partners, and we'll get to that in here. So there's a lot of stuff going on. We could really talk about China all day. It's a fascinating area, and as I said, it really is the area that drives so much of our policy, or at least investment policy, in really every asset class, especially currencies. Quick disclaimer, and we have Steve's. We'll come back to this. This is really about the ISE FX options is set up here, and I'll let Steve explain that when he goes. This is China is the big dog of growth and money flow. This is really why we're paying so much attention to China. It really is the capital gain opportunity in the world at the moment. It's really sucking in money from everywhere, whether it's commodities because of the commodities demand. They're the big driver of commodities demand, as we all know. A lot of real property investment in terms of the manufacturing side from major manufacturers want to get a bulkhead in China, we all know. But also there's some major spec in their real estate market, again, to get into this. A lot of players around the world have put a lot of money, and a lot of it has come out because of the credit crunch, but still there's a lot of money sitting there in real property investments, especially in real estate, expecting some type of one-off currency appreciation in China because their currency looks like it's very undervalued, and we'll get to that. So it's the driver of that. It's the driver really of a lot of things that the Asian bloc does because of the way China handles its policy and the fact that China really is sucking the wind out of the entire region in terms of the export driver. Think of it this way. The Asian bloc has to compete against China for competition to the West. Not only has China been a big benefit for them because they're exporting into China, but it's also been a detriment on some of the areas where they compete. So that's a very important what China does in terms of how it impacts their policies regarding their currencies, and will have a big impact on their currencies going forward. And we'll get to some of those scenarios, really what paths we can really consider here on the last slide and talk about that in more specifics. And, of course, China is a big driver of U.S. dollar sentiment because of the fact they hold so many treasuries, they hold so much of our paper, and I'll show you why they hold so much of our paper and why in the future they may not need to hold so much of our paper. And also this whole idea of hegemony. China, the power will continue to shift to China. That type of thing. Sooner or later, China or an Asian bloc currency will be the world reserve currency. This is the belief out there. So China makes noises about the world reserve currency. When China makes noises about the dollar, it really impacts and flows directly into dollar sentiment because of all this stuff, all the paper that they're holding and how important they are in terms of their ongoing relationship with the U.S., even been termed now the G2, China and U.S., because that relationship on an economic relationship and the butting heads on the political side of the fence really is the key relationship that everybody's watching at the moment, and for good reason. Just kind of show you where China is. A lot of people don't really understand how big they are or how small they are, depending on how you want to look at it. This is a GDP comparison, 2008, and it's based on purchasing power parity, trying to equalize what a currency would buy across an international basket of goods. And if we revalued China in terms of their purchasing power parity, they're the second largest economy in the world. You can see the U.S. is still the biggest, 14.2 trillion. China second on a purchasing power parity. Japan third, India, and Germany. Now, if we take the official exchange rate of China and value their GDP, it's much smaller at $4.2 trillion. You can see, even if you look at China and you look at this and go, at a purchasing power parity, that's a massive undervaluation of the currency right there if you look at it. So when they talk about their currency being fairly valued, it's really kind of laughable. So now this is why we asked every day, WWCD, what will China do? It really is a question we ask every day when we wake up in the investment world, because the noises they make really tend to drive everything.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.